Hello, everybody. Today is another day, meaning new episode, new things to learn. I am Limuel, and this is Tax 101. In this video, we will be tackling two cases related to the important concepts in taxation, namely allowable deductions from gross income and the withholding tax. First, we are going to discuss allowable deductions from gross income. Gross income covers all income derived from whatever means. However, domestic corporations and resident foreign corporations are allowed to claim deductions either through optional standard deductions or OSD or through itemized deductions. The election to claim OSD or itemized deductions must be signified in the income tax return filed for the first quarter of the taxable year. Once the election is made, it shall be irrevocable for the taxable year from which the return is made. It is a basic principle in allowable deductions from gross income that the taxpayer must point to some specific provision of the statute authorizing the deduction, and he must be able to prove that he is indeed entitled to the deduction authorized or allowed. To understand this better, let us look at the case of Philippine Refining Company Incorporated or PRC as petitioner versus the Court of Appeals, the Court of Tax Appeals, and the Commissioner of Internal Revenue as respondents. GR number 118794, May 8, 1996. In this case, the SCA discussed the requirements for debts to be considered as worthless and therefore making them deductible. Here, petitioner, the PRC, was assessed with the respondent Commissioner of Internal Revenue to pay a deficiency tax for the year 1985 in the amount of 1,892,584 pesos. The assessment was timely protested by the petitioner on the ground that it was based on the erroneous disallowance of bad debts and interest expense, although the same are both deductible and the same are both allowable and legally deductible. Petitioners accordingly filed a petition for review with the Court of Tax Appeals on the same assignment of errors, that is, that the bad debts and interest expense are legal and allowable deductions. The Court of Tax Appeals reversed and set aside the Commissioner's disallowance of the interest expense, but maintained the disallowance of the supposed bad debts of 13 debtors. Petitioner then elevated the case to the Respondent Court of Appeals, which denied due course of the petition for review and dismissed the same for failing to satisfy requirements of worthlessness of a debt. The issue in this case is whether or not the petitioner satisfied the requirements of worthlessness of debts as to the 13 accounts disallowed as deductions. The court ruled that no, the petitioner failed to satisfy the requirements of worthlessness of a debt as to the 13 accounts disallowed as deductions. For debts to be considered as worthless and thereby qualify as bad debts, making them deductible, the taxpayer should show that first, there is a valid and subsisting debt. Second, the debt must be actually ascertained to be worthless and uncollectible during the taxable year. Third, the debt must be charged off during the taxable year. And fourth, the debt must arise from the business or trade of the taxpayer. Additionally, before a debt can be considered worthless, the taxpayer must also show that it is indeed uncollectible even in the future. Furthermore, there are steps outlined to be undertaken by the taxpayer to prove that he exerted diligent efforts to collect the debts, vis-a-vis sending of statements of accounts, sending of collection letters, giving the account to a lawyer for collection, and filing a collection case in court. It appears that the only evidentiary support given by PRC for its aforesaid claim deductions was the explanation or justification posited by its financial advisor or accountant. Her allegations were not supported by any documentary evidence. Hence, both the Court of Tax Appeals and the CTA ruled that said contentions per se cannot prove that the debts were indeed uncollectible and can be considered as bad debts as to make them deductible. The contentions of PRC that nobody is in a better position to determine when an obligation becomes a bad debt than the creditor itself, and that its judgment should not be substituted by that of respondent courts, as it is the PRC who has the facilities in ascertaining the collectability or uncollectability of these debts, are presumptuous and uncalled for. The Court of Tax Appeals is a highly specialized body specifically created for the purpose of reviewing tax cases. Through its expertise, it is undeniably competent to determine the issue of whether or not the debts are deductible through the evidence presented before it. The court vehemently rejects the absurd thesis of petitioner that despite the supervening delay in the tax payment, nothing is lost in the part of the government because in the event that these debts are collected, the same will be returned as taxes to it in the year of the recovery. This is an irresponsible statement which deliberately ignores the fact that while the government may eventually recover revenues under that hypothesis, the delay caused by the non-payment of taxes under such contingency will obviously have a disastrous effect on the revenue collections necessary for governmental operations during the period concerned. Accordingly, the petition at bar is denied, and the judgment of the Respondent Court of Appeals is hereby affirmed. Oh, that is it for our first topic. Moving on, we are going to discuss withholding tax. But wait, do you know what withholding tax is? Well, withholding taxes are taxes imposed or prescribed by the NIRC to be deducted and withheld by the payer corporations and or persons, for the former to pay the same directly to the BIR. Hence, the taxes collected are practically at the same time the taxes collected practically are the same time the transaction is made or when the taxable transaction occurs. It is taxation at source. The duty to withhold is different from the duty to pay income tax. Indeed, the revenue officers generally disallow the expense claimed as deductions from gross income if no withholding tax as required by law or regulations was withheld and remitted to the BIR within the prescribed dates. So in the second case, we have the RCBC or the Rizal Commercial Banking Corporation as petitioner versus Commissioner of Internal Revenue as respondent. GR number 17257, September 7, 2011. So petitioner RCBC is a corporation engaged in general banking operations. It seasonably filed its corporation annual income tax returns for foreign currency deposit unit for the calendar years 1995 and 1994. 1994 and 1995. RCBC received a formal letter of demand together with assessment notices from the BIR for deficiency taxes assessment. Disagreeing with the said deficiency tax assessment, RCBC filed a protest and later filed a petition for review before the Court of Tax Appeals, pursuant to Section 228 of the 1997 Tax Code. On December 6, 2000, RCBC received another formal letter of demand with assessment notices, and on the same day, RCBC paid the deficiency taxes as assessed by the BIR. However, it refused to pay the assessments for deficiency final tax on the FCDU onshore income and documentary stamp tax. RCBC contended that because the onshore tax was collected from a final withholding tax, it was the borrower, constituted by law as the withholding agent, that was primarily liable for the remittance of said tax. The Court of Tax Appeals First Division promulgated its decision, which partially granted the petition for review. It considered as closed and terminated the assessments for deficiency income tax, deficiency gross receipt tax, deficiency final withholding tax, deficiency expanded withholding tax, and deficiency documentary stamp tax. Don't worry, these are not the industry issue in this case. This is for just for discussion purposes. Yes. It was, however, upheld that the assessment for the deficiency final tax on the FCDU onshore income and the deficiency documentary stamp tax for 1994 and 1995 and ordered RCBC to pay amounts plus 20% delinquency tax. Unsatisfied, RCBC filed its motion for reconsideration. The CTA First Division substantially upheld its earlier ruling, except for the inadvertence in the addition of the total amount of the deficiency taxes. The RCBC elevated the case to the CTA and Bank. The CTA and Bank denied the petition for lack of merit. It held that because the payer-borrower was merely designated by law to withhold and remit the said tax, it would then follow that the tax should be imposed on RCBC as the payee bankee. Finally, in relation to the assessment of the deficiency documentary stamp tax on petitioner's special savings account, it held that petitioner's special savings account was a certificate of deposit and, as such, was subject to documentary stamp tax. Hence, this petition before the Supreme Court. The issue in this case is whether petitioner as payee bank can be held liable for the deficiency onshore tax, which is mandated by law to be collected at source in the form of a final withholding tax. The court ruled that yes, petitioner RCBC is liable for the deficiency onshore tax. In Chamber of Real Estate and Builders Association versus the Executive Secretary, the court explained that the purpose of the withholding tax is threefold. First, to provide the taxpayer with a convenient way of paying his tax liability. Second, to ensure the collection of tax. And third, to improve the government's cash flow. Under the withholding tax system, the payer is the taxpayer upon whom the tax is imposed, while the withholding agent simply acts as an agent or mere tax collector of the government to ensure the collection of taxes, as in the case of Commissioner of Internal Revenue versus Court of Appeals, which, for quotation, it states that the withholding agent's liability is direct and independent from the taxpayer, because the income tax is still imposed on and due from the latter. The agent is not liable for the tax as no wealth flowed into him. He earned no income. The tax code only makes the agent personally liable for the tax arising from the breach of its legal duty to withhold, as distinguished from its duty to pay tax, since the government's cause of action against the withholding agent is not for the collection of income tax, but for the enforcement of the withholding provision of Section 53 of the Tax Code, compliance with which is imposed on the withholding agent and not, and the compliance with which is imposed on the withholding agent and not on the taxpayer. Based on the foregoing, the withholding agent cannot be made liable for the tax due because it is the latter who earned the income subject to withholding tax. The withholding agent is liable only insofar as he failed to perform his duty to withhold the tax and remit the same to the government. The liability for the tax, however, remains with the taxpayer because the gain was realized and received by him. While the payer-borrower can be held accountable for its negligence in performing its duty to withhold the amount of tax due on the transaction, RCBC as the taxpayer and the one which earned income on the transaction remains liable for the payment of tax as the taxpayer shares the responsibility of making certain that the tax is properly withheld by the withholding agent, so as to avoid any penalty that may arise from non-payment of the withholding tax due. RCBC cannot evade its liability for FCDU onshore tax by shifting the blame on the payer-borrower as the withholding agent. Whew. So that was it. That was both of our chosen cases. Again, as a review, in the case of PRC versus CA, the contentions of PRC that nobody is in a better position to determine when an obligation becomes a bad debt than the creditor itself, and that its judgment should not be substituted by that of respondent court, as it is the PRC who has the facilities in ascertaining the collectability and uncollectability of these debts, are presumptuous and uncalled for. The Court of Tax Appeals is a highly specialized body specifically created for the purpose of reviewing tax cases. Through its expertise, it is undeniably competent to determine the issue of whether or not the debt is deductible through the evidence presented before it. While, in the second case of RCBC versus CIR, it talks about the purpose of the withholding tax system, which is threefold. First, it provides the taxpayer with a convenient way of paying his tax liability. Second, it ensures the collection of taxes. And third, it improves the government's cash flow. Under the withholding tax system, the payer is the taxpayer upon whom the tax is imposed, while the withholding agent simply acts as an agent or a mere tax collector for the government to ensure collection of taxes. The liability of the withholding agent is direct and independent from the taxpayer because the income tax is still imposed on and due from the latter. The agent is not liable for the tax as no wealth flowed into him since he earned no income. Oh. So you may find, so that is all. And for our closing remarks, you may find it hard to understand the concepts, especially when it is your first time. But we hope that through this video, you finally have the grasp on how taxes, grasp, you'll finally have a grasp about how taxes, specifically the concepts of allowable deductions from gross income and withholding tax. Uh, Take two. Thank you very much. Blah, blah, blah. You may find it hard to. Thank you very much for listening to our discussion and our chosen cases. And you may find it hard to understand the concepts, especially when it is your first time. But we hope that through this video, you'll finally have a grasp about how taxes, specifically the concepts of allowable discussions from gross income and withholding tax work. So we hope you learned something from today's episode. Again, we are the Group 5 composed of Borja, Gadin, Montes, and Tayobong. And see you again in the next episode of Tax 101.